thankfully, there are two things you can do to help protect yourself against underpayment penalties. The first one is a safe harbor provision, which states that you have to pay 110% of your previous year's tax liability to avoid any underpayments. So for example, if last year your tax liability was $100,000, if you make at least $110,000 worth of payments, so 110% of last year, then you shouldn't be subject to underpayment penalties. The IRS assumes that you earn your income equally throughout the year. So you can just make a $110,000 payment before January 15th and call it a day. The second is the annualized installment method. So as I mentioned, the IRS assumes that you earn your income equally throughout the year. So you can't just wake up on January 1st and make your entire safe harbor payment for the whole year. Because you haven't paid throughout the year, you would be hit with some penalties. So because of that, they allow you to file the annualized installment method on your tax return to smoothen out your income throughout the year if you receive most of it in the fourth quarter. So talk to your accountant about that to make sure that they help you file that on your return. So while these strategies help you avoid underpayment penalties, they won't solve your cash flow problem. So what's the best way to stay ahead? I recommend two things to my clients. Number one, hire a competent tax accountant that specializes in working with big law partners that are familiar with multi-state tax filings and all the other intricacies of being a partner in big law. Now you can expect to pay between $2,500 and $5,000 for your return, depending on where you are and the complexity of your return. But again, trust me, it's well worth paying those dollars to accurately file your return. Number two, open a high yield savings account dedicated for taxes. So what you're going to want to do is every time you get paid, whether it's a draw, early distribution, or a bonus, is set aside a set percentage that you predetermine with your CPA and transfer directly to that account automatically. So let's say you established that you wanted to transfer 40% of every time you get paid, and let's say you get a $20,000 draw where you're going to send $8,000 to your high yield savings account. And then when the quarterly tax payment is due, you just pay straight out of that account. So it's kind of out of sight, out of mind. So this ensures that you don't spend money that is actually not yours.